Hi, Catherine.
Hi, Anushka. How are you?
Good, thank you. How are you?
Doing well, thank you. Thanks for asking.
And thank you for joining again for our latest installment of our Climate Responsibility in Banking series. And this time we'll be talking about banks and how they're moving to a greener energy solution and moving away from the fossil fuel industry. There's a lot of talk of financed emissions. And I'd love to ask, what are a bank's financed emissions? What does that mean?
Yeah, great question. Thank you. Financed emissions are emissions that are enabled by banks lending. So without that lending, without that loan, those emissions would not exist. So let's say a bank lent 10% of the capital that's required to construct a oil pipeline, right, to a pipeline operator. The pipeline operator would then measure their emissions from the construction and operation of that pipeline. Say it's 1 million tons. And the bank would account for 10% of that because they contributed 10% of the capital. So they are essentially responsible for 10% of emissions coming off from that project. So that would be 100,000 tons of CO2. So this is a lot, but this is just an example of how we would calculate emissions. And to give you a sense of perspective, an individual's carbon footprint is anywhere between 1 and 12 tons, depending where you are in the world. So when you're looking at financed emissions, that hopefully gives you a kind of a sense of perspective as to how to evaluate the numbers that you're actually seeing. And that's 1 to 12 tons per year. There's actually an established protocol for this, which is called PCAF, if you want to get really technical. And in our rating methodology, we actually give extra points to banks that apply this gold standard for emissions measurement. Now, when measuring emissions, there are all sorts of different loopholes and greenwashing opportunities for banks. There are different types of emissions. They're called scopes, but anyway, they're different types of emissions. And so banks can actually cherry pick and see which ones they're accounting for. But if they're following PCAF, this gold standard, that means that we're taking the entirety of the emissions from that project, a pipeline in this case, and then accounting for that percentage that they've contributed. So that's financed emissions. Probably the most interesting thing about financed emissions is if we look at a bank's total carbon footprint, so from direct emissions, so from burning of, say, a natural gas on premises, to all the things that the bank buys, to operating their premises and branches, financed emissions for banks is around 99% of their total emissions. So their operational emissions just pale in comparison compared to their financed emissions. And that's why it's so important for us to demand from banks that they really fully account for their financed emissions, because that gives you a sense of how much they're actually enabling in terms of this carbon footprint.
Thank you, Catherine. That brings a lot of clarity. And my next question is, are banks facing pressure to support cleaner energy projects? And if so, by whom?
Yes, there's definitely pressure, but in many cases, it's actually commercially beneficial. Renewable energy and generation of energy and electricity from renewable energy sources is the cheapest energy that there is already. So the economics of clean energy is such that it actually very beneficially to fund before you even face any sort of pressure to do so. The problem is, because of various misalignment of incentives and external costs that haven't been internalized. So, for example, the fossil fuel industry is on the receiving end of a lot of incentives, tax incentives, for example. On the face of it, fossil fuels very often appear to be a better investment or better lending prospect in this case. I recall that Darren Woods, the CEO of Exxon, was asked about why Exxon doesn't invest more in renewable energy projects. And he was very open about that. He said, look, renewable energy projects do make money, but not nearly as much as fossil fuels. So therefore, we're not budging on our fossil fuel to renewable energy ratios. So from a bank's perspective, it does make sense. But as I said, because of all this misaligned incentives, on the face of it, it appears that fossil fuels are a good investment. And then there's investors. So investors in banks, they can put pressure on banks as well, particularly large asset managers that manage those investments for their owners. Again, we think about the way the financial system works. So we have asset owners, your pension funds, your university endowments, family offices. They invest, and they typically use asset managers, and then asset managers invest in corporates, including banks. They can put pressure and say, I don't want any fossil fuels in my portfolio. I actually want you, BlackRock and Vanguard, to be investing in cleaner banks for me. So there's that. And then finally, there's activists like us and grassroots demand for better options, cleaner options, and seeing that banks move us along to that future where we're funding a lot more clean energy projects than fossil fuels. And that's why Bank Green exists, to help individuals play a part in that transition.
Cool, thank you. And that's a good segue into my next question, which is, how are banks moving away from dirty energy?
Yes, so several ways. First, some already have those policies in place. Some of them are in the process of formalizing them, but you could place a policy to state that I will not lend to a certain number of industries, high carbon industries, not only fossil fuels, arms, etc. And we call them exclusion policies. So that's the kind of industry term. So a bank can put in place an exclusion policy, say, if I'm approached by a fossil fuel company, I will not provide any support to them. Then we have another way, which is more gradual, and that is essentially just ramping up funding of clean energy projects while also reducing financial support for fossil fuel companies and projects. And so essentially what that means is not providing any new loans, and if existing loans come up for renewal, again, just not renewing them, and so gradually increasing that ratio, which is a very critical ratio that we look at when we rate banks, of renewable energy to fossil fuel lending. Another way that banks clean up their portfolios of loans is by introducing green products. And so these are products that are targeted at individual consumers. Examples of this would include loans to purchase electric vehicles or energy improvement loans. It's smaller in terms of overall impact because we're dealing with small consumer products. The scale of it is not as large as, say, financing a massive renewable energy like solar farm, for example, but still that's a good way for banks to also contribute to moving us away from fossil fuels.
Thanks. And my last question for today is, how can I help and nudge my bank to become more sustainable?
Yes, great question. First of all, check our website, right? See how your bank is doing and then decide if you need to take action. If your bank is missing, we do have a lot of banks in our database, but this certainly doesn't have every single one that exists under the sun. So if your bank is missing, let us know and we will rate it. It is entirely possible that your bank hasn't disclosed sufficient information for us to draw any sort of conclusions. And if you are a customer, then as a bank account holder, you can use your power to pose some of these questions directly to the bank, and we can support you by drafting some suggested language that you can use, that you can ask smart, intelligent questions about their mix of fossil fuels, renewables, about their policies, about their green products, about where they are on their decarbonization journey. So yes, that's how you can help.
Great, thank you. That's valuable. That'll be very valuable to all of our listeners and our followers at Bank Green. So thank you so much for tuning in again in our Climate Responsibility in Banking series. And I'll see you next time. Bye.
Bye.